This week, Lyft is going to announce the pricing for its new IPO. The IPO is happening on Friday. Now, let's understand a couple of things. First, IPOs are very exciting opportunities. Lots and lots of money get made by IPOs, not always by the people that you think. Let's take a little look at this because this is an exciting one. It's going to catch a lot of business news, and I want you to have a little bit of the inside track on how this works. Number one, when an IPO happens, it's the only time in all the stock market trading cycle that the money actually goes to the company. Most of the time, investors are trading shares of stock back and forth between themselves, and that has nothing to do with the company. So the IPO is the initial public offering, the first time that the company actually sells stock to the public and anybody can buy it. So there's a couple of factors that are really important. Number one, they want to price the stock as high as they can, because if they price the stock and they're estimating 62 to 81. If they price the stock at 62 and the stock goes up to 100 and then people start trading at 100, they're leaving a lot of money on the table. So they want to price the stock as high as they reasonably can, but they want to make sure that they sell all the shares that they're putting out there, because if they don't sell all the shares, then they come up with less money than they expected. So they want to make sure that that happens. So they're anticipating selling these shares somewhere between 62, probably in 68 or 70, but they could go as high as 80 because their documentation has to specify a ceiling. They specify that information, and what that means is that that company would be worth about $23 billion in accumulated value for all the people that hold the shares. That's a really big number, especially for a startup. So, especially for a startup, by the way, that lost $911 million last year. But the company indicates that most of that money that they lost is probably because of economies of scale that they're going to get over time as they get a little bigger. And remember, Uber is going to be doing an IPO here pretty shortly as well. So, but they're going to get these economies of scale. The biggest economy of scale is going to probably be surprising, mostly to the drivers for Lyft, maybe not so much for the investors. Here's the deal, is that we are on the verge of launching lots and lots of these autonomous cars. Right now, the Lyft drivers, the Uber drivers, they all get 75%. The company gets 25% for pushing them the customer. When there are autonomous cars, instead of paying 75% as a variable cost every single time there's a ride, the company will buy a car and then they'll keep 100% of all the money that comes in, and they'll run it in a much more efficient, much more high profitable way. So the drivers that are currently driving are helping Lyft and Uber to build their businesses in a way that will allow them to get rid of those drivers not very long from now, and then have their profit margins and everything else skyrocket once that happens. So this trend is on the horizon. Lyft is well aware of it. Uber is well aware of it. The only people who probably aren't thinking about it are probably the drivers who are about to get outed here pretty quick. So that's a big and important factor. Who makes all the money in the IPO? Is it the guy that buys the shares at $65 or $70 when they first come out? One of us, the retail investors? Not exactly. The purpose of the IPO is to unlock the money that all these other shareholders already have. So there are investors, professional investors, Shark Tank investors, venture capital investors that bought these shares at $1, $2, $3. Maybe they bought it even for way less. The founders of the company, and maybe the early employees might have got it for a nickel or 10 cents or something very low. But those people have hundreds of millions of dollars of paper that they can't spend. And once there's an IPO, they sell those shares, because now those shares go public, and they can now trade those shares for actual cash. So they can either retain the shares and hold them as investment equity, or they can sell some of those shares and use the cash to do whatever they want. But that's the most important thing that happens in an IPO, is it unlocks all the value and profit that already exists. The profit didn't come because of the IPO. The IPO is what unlocks the value for the other people. So they've been working on this business for 5 or 8 years, and now they're going to get their release and they're going to start getting their cash, because everything that they've done has just been phantom profits so far. So lots of excitement on the horizon, lots of IPOs on the horizon, but it's important for me to help give you the inside track on exactly how these businesses make their money, how you're going to make your money. And if you're going to be smart, you're going to do these kinds of activities, then at the very least, take the inside track so you can profit from the inside and the inside insights that we're going to provide to you here. I'm Joel Block. Have a great rest of your week.